Did you know that during the Dutch Tulip Bubble, some tulip bulbs sold for more than the price of a house? Yeah, you heard that right. Imagine paying more for a flower than for a roof over your head. Welcome back to the channel, everyone. Today, we're diving into a fascinating piece of history that's both mind-blowing and a little bit hilarious. We're talking about the Dutch Tulip Bubble, which is often considered the first economic bubble in history. This event is not just a quirky story about flowers, it's a significant lesson about human behavior, speculation, and the economy that still resonates today. So, grab your favorite drink, sit back, and let's explore this wild ride through the tulip craze of the 17th century. Okay, let's set the stage. The 1600s in the Netherlands were a time of prosperity and growth, and tulips became the hottest commodity on the market. People started to invest in tulip bulbs like they were gold. The problem? Speculative investing. Folks were buying and selling bulbs, often without ever intending to actually grow them. It was a classic case of FOMO, or fear of missing out, where everyone wanted a piece of the action, believing prices would keep climbing forever. But this kind of speculation created an unsustainable economic situation. Prices soared to ridiculous heights, and many people were left holding the bag when things turned, having invested their life savings in flowers that, let's face it, were just pretty plants. Now, let's dig deeper into how this all started. The story of tulips in the Netherlands goes back to the late 1500s when they were introduced from the Ottoman Empire. At first, they were just a rare and exotic flower, cherished by the elite. But as time went on, tulips became a cultural symbol of wealth and status. By the early 1600s, the craze really took off. People weren't just planting tulips in their gardens, they were trading them like stocks, creating a market that was wildly inflated. So, how did this market actually work? Well, there were these things called futures contracts. Investors would agree to buy tulip bulbs at a future date for a set price, betting that they could sell them for even more later on. This led to crazy price increases, with some bulbs selling for more than 10 times the average annual income of a skilled worker. It was a time when people believed they could get rich overnight with just a little luck and a lot of speculation. But as we know, what goes up must come down. And then came the turning point. By the winter of 1636, tulip prices reached their peak. People were going absolutely nuts, and it seemed like the bubble would never burst. But in February 1637, the unthinkable happened. Buyers suddenly vanished. Investors started panicking, and tulip prices plummeted. Many went bankrupt overnight. Those who had invested heavily were left with nothing but a handful of bulbs, as their value collapsed. It was a financial disaster for countless individuals and families, and the aftermath left a lasting impact on the Dutch economy. The bubble had burst, and it was a harsh lesson about the dangers of speculation and greed. So, what can we take away from the Dutch Tulip Bubble? This historical event teaches us valuable lessons about economics, human behavior, and the risks of speculative investing. It reminds us that markets can be driven by emotions and trends rather than actual value. Just like today, where we see similar patterns in various asset classes, the tulip bubble serves as a cautionary tale against getting swept up in the hype. The rise and fall of tulip prices is a powerful reminder that, in the end, what really matters is the intrinsic value of what we invest in.